Hello, everyone. Happy New Year. Thank you for listening to us today. It's great to be here. So I've been in Singapore for 7 years now. And many times people ask me, what do you like about Singapore? What do you like about living in Asia? And I tell them, one of the things I like about living in Asia is the food. We have a lot of food variety. You can have different types of food. And when you think about even Japanese food, we all like to go to Japan. It's even a lot of stuff going on there, right? You go to Japan, you go to a restaurant, you open the menu, 12 types of whitefish, 4 types of tuna, 5 types of salmon cuts. You have the cooked food, you have fish, you have beef, and you're like, where do I start? How do I pick the best food to have when I'm traveling and there's so much variety, right? And the very interesting concept that we have when we think about food is the omakase, right? And what is the omakase? Omakase is where that professional chef, the person who understands what they're doing, they're picking that for you. They're picking that for us. So they're looking not only at what is fresh, what is the fresh fish, what is the fresh ingredients, what it's in season, but most important, what the omakase chef is looking at is, how do I balance all of that together in a meal? I can not only serve you salmon, I can only serve you cooked food, I need to serve you a balanced meal with a little bit of everything, and that's the skill that chefs brings to the table. So you might be asking, why is this guy talking about omakase and sushi? We're not in a cooking conference. It's because when it comes to investments, we are also faced with a lot of options. Many of you today are thinking, should I invest in equities? Is equities expensive? Should I do global equities, US equities, European equities, emerging market equities? When it comes to fixed income, what should I do? There's a lot of options out there. So today what I hope to do is to bring you a little bit more information and hopefully a solution similar to the omakase chef, a solution that can help you pick, or we help you pick, what's the best investments out there, but most importantly, how can we balance those investments together? So today I'm going to talk to you about what we call the PIMCO Balanced Income and Growth. We call it PBIG. And PBIG is a very simple fund. It invests 60% in global diversified equities, so the best stocks that we can find in the globe. It invests 40% on high quality fixed income. And this is really important, and I'm going to go back to this, why I'm saying high quality fixed income. The PBIG also has a distribution of 7% per annum. So as a client, you're getting those distribution on a monthly basis. And last year, phenomenal performance. Actually, since inception, phenomenal performance. Last year, the fund was up 12% after fees. So if you think about a 12% performance, you're getting paid 7, and you still have your 5% appreciation on top of that. So this is PBIG, and this is what we're going to be talking to you today. Before we go there, maybe I'll talk to you a little bit about PIMCO. Many of you know PIMCO. We are a $2 trillion investment management firm. Our headquarters is in Newport Beach, California, in the US. We've been around for over 50 years, and we've been in Singapore since 1996. So we've been here in the region for a long time. A lot of you might know PIMCO for being the largest active fixed income manager in the world. And yes, we are the largest active fixed income manager of the world. But something that many of you might not know is we also have a very, very strong equity team. So PIMCO has been doing equity since 1986. We started doing factor investing in 2004. And throughout that 35 years, we've been adding to the team, adding different strategies, and today we have a platform that is almost $50 billion. So again, yes, we are the largest active fixed income manager of the world, but also a very, very strong equity platform. Now let me take a step back and tell you a little bit about how PIMCO is thinking about the macroeconomic outlook for the next 12 months. The first point here is growth. We think that growth will continue to be strong, especially in the US. Donald Trump is coming back as president. He is already talking about pro-growth policies. So we should expect Donald Trump to continue to stimulate the US economy. So we think growth will continue to be strong and resilient. When you think about inflation, a lot of people were scared about inflation. You know, will Donald Trump come back? Will inflation go up? Our view is that inflation will continue to be range bound. This Wednesday, the inflation numbers came in. It was below expectation. That's why markets got a little bit calmer. And we also believe that inflation will be range bound throughout the year, which means that the central banks throughout the world, but especially the US Central Bank, the Federal Reserve, will continue to cut rates. Last year, people were thinking the Fed was going to cut rates 4 times this year. We think they will probably cut rates 2 or once, but still, the Fed will continue to cut rates, and other countries like UK and Australia will also cut rates. So what does it mean for all of you? Positive growth, controlled inflation, and central banks cutting rates. Equity markets should do well in this environment, given the growth and inflation. And when you look at fixed income should also do well, because central bank will continue to cut rates. And most important today, fixed income has a starting yield of around 7%. A high quality fixed income portfolio has a starting yield of 7%. So fixed income is looking very attractive, and equity should continue to do well. 60-40. Why did we decide to do a fund that is a 60-40 fund and have global equities and high quality fixed income? So I'm going to show you 2 evidence on why we think 60-40 is very important for your portfolio. The first one here is we looked at data since 1990. And what you can see here is that the red dot represents global equities, global stocks, and the green dot represents a 60-40 portfolio. You can see they're in the same height. That means that a 60-40 portfolio has given you equity-like returns. So returns very similar to equities, but as you can see, they're far apart from each other, which that means a 60-40 portfolio has 40% less risk. So again, equity-like returns, but with 40% less volatility and less risk. So this is what we think is very important. So if you're sitting in fixed income and cash and you say, I need to add a little bit more, you don't need to go all the way into equities. You can stay in a 60-40 and get equity-like returns with less risk. If you're thinking, I have a lot of equities and there's an uncertain world out there, you can shave some of your equity and put in a 60-40 portfolio. You're not going to miss too much on returns, as you can see here, but you're going to take less risk. The other slide I wanted to show you is this one. Again, same data since 1990. A 60-40 portfolio would have given you a 7% annualized return since 1990, with only 2 periods of negative return when you look at a 3-period window. So 60-40 tends to be also very resilient. And if you just had close your eyes, invest in a 60-40, and let us do the rebalancing for you, you would have almost quadrupled your money. So 60-40 is a really good place to start. So now let me talk to you about our fund that has a 60-40 framework, and we do things a little bit different than competitors, so I would like to explain to you what we're doing there. So the first thing is there's 3 engines of growth for our fund, 3 engines of return. So think about an airplane. Would you rather go on an airplane that has one engine? Would you rather go on an airplane with 2 engines, or you would rather have an airplane of 3 engines? I would rather be on a plane with 3 engines. So when you think about a fund, would you rather have a fund with 1 engine of returns, 2 engines of returns, or 3 engines of returns? We prefer having 3 engines of returns because it also diversifies your risks and it diversifies your chances of success. So this is what we're doing in our fund. The first engine of return is our global equity portfolio. Here we're looking at the best equities we can find globally, and I'm going to go a little bit deeper into what we're doing there. The second engine is fixed income, As you know, we're the largest fixed income manager in the world, and what we're doing here, we're picking high quality fixed income that can balance the equity book. And I'll talk to you a little bit more about that as well. And then finally, using PIMCO's expertise in macro, we're looking at macroeconomic data every week, and we're tweaking the portfolio to mitigate the downside, but also capture the downside depending on the macro data. So now I'm going to walk you through the 3 different components here. So the first one is our equity. So what are we doing in equity? It's pretty straightforward. We're looking at 4 themes. The first theme is quality. What does quality mean? That's the financial health of the company. How well is the company doing in its finance? The second one is valuation. Valuation means, is that stock expensive? Is that stock cheap? So how are we looking there? The third is momentum. How's the price move? And then the follow is growth. What is the growth potential of those stocks? So we start with the index, the MSCI World Index, 3,000 stocks. We look at each one stock with these 4 themes I said, and we rank them from 1 to 100, which are the best and which is the worst based on these 4 themes I spoke about. And then we look to buy the top companies, and we have a portfolio of 300 to 500 stocks. We're looking at that portfolio every day, and we're rebalancing every month. So a very straightforward, very transparent approach that has been generating alpha for our clients above the benchmark. When it comes to the fixed income book, this is very important. This is where we're really focusing on high quality fixed income. And why do I mention that? A lot of funds out there in their fixed income book, what they're doing high yield. High yield bond has a very high correlation with equities. What does that mean? When equity goes down, high yield goes down. When equity goes up, high yield goes up. So they don't balance each other out. When you think about a fixed income book can actually balance the equity part of the portfolio. So last year, in July and August, when the equity markets were very volatile, this fixed income portfolio was very stable. So provide investors a lot of stability during moments of volatility. So that's why we think that having a high quality fixed income portfolio is very important for this strategy. As you can see here, the average quality is investment grade. And then finally, as I mentioned, we're tweaking these 4 components of the fund, duration, credit, equity, and currency, to manage downside risk, but also capture upside potential. So we're looking at weekly macroeconomic data. As that data comes in, the portfolio managers are looking at that and says, what should we do in these 4 components? And this has also added return to our clients. I think at the end of the day, we all want performance. The story can be great, the strategy can be great, 60/40 can be great, but how has this delivered to clients? And I'm really happy to let you know that the performance has been phenomenal, has been very strong. But most importantly, the 3 engines has worked. So as you can see on the right side of this slide, the equity component, the fixed income component, and the tactical component, they all added to returns. And this is what I like about this fund, because the chances of success is higher when you have 3 engines of return working for you versus having 1 or 2. We are right now in the first quartile of all of our competitors. Actually, we're in the top 7% of our Morningstar category. So this fund has done very well. Last year, the fund was up 12% after all fees, and we have a share class that distributes 7% of that. So you as a client, you're getting 7% distribution, but you also have the upside potential that you can see here. This fund has a US dollar share class. This fund has also a Singapore dollar share class, so we do have multiple currencies. This fund is available in the FSM platform, so you can buy it. It's ready. It's daily liquidity, so very easy to access. So my final point here is that I'll summarize what I spoke to you today. PBIG, the PIMCO Balanced Income and Growth, is PIMCO's flagship 60-40 portfolio. We're investing 60% on global diversified equities. We're investing 40% on high-quality fixed income, and that high-quality fixed income is very important. The fund has a distribution of 7% per annum. We pay that distribution monthly with a very, very strong performance, very strong track record. Last year, the fund was up 12% net of fees. We have the PIMCO booth right over there. I'll be there. All my colleagues are there. So if you have any questions, please stop by. And once again, thank you so much for all of your support and listening to me today. Thank you so much.